Rate cuts are often considered bullish for risk assets such as cryptocurrencies and tech stocks, but what does the recent Fed hawkishness mean for risk sentiment? Elevated yields on treasuries, seen as a risk-free alternative to equities because they're backed by the U.S. government, are also a headwind to stocks. Typically, a hawkish Fed weighs on stock prices and valuations, which are pricing in earnings growth or have high debt levels on their balance sheets. This is why the Nasdaq, which has a huge amount of growth stocks, typically suffers during a period of a hawkish Fed. In addition, the speed of the Fed's balance sheet reduction is almost as important. The more quickly the Fed reduces its assets, the higher the risk to the market and typically the more volatile the market may get. Just as hawkishness is typically bearish for the equity markets, the same can be said for the crypto market. The aforementioned higher borrowing costs attract investors to safer assets like treasury bonds. Gold has one of the strongest inverse correlations with U.S. real rates among all asset classes, and historically as rates rise, non-yielding assets like gold suffer. When looking at the dollar, a more hawkish Fed provides tailwinds, especially versus other currencies like the euro and the yen. But despite Powell and the Fed's hawkish tone since last week's Fed meeting, these overall markets have held strong in the face of a rate environment that may not be declining as quickly as many had hoped.